let's move on to the issue of risk, which is obviously the critical issue. I'm going to throw in the question that some analysts have been asking as to whether or not the creation of a CCP actually encourages some dealers to be less rigorous about the original counterparties that they've traded with, and therefore does that actually create more risk rather than less risk? That might be a slightly simple way of looking at it, but Kim, do you have any views on that? Is that an argument that you come across frequently?
I don't think we get asked that question very frequently, but I would say that although to some extent having a central counterparty service I think does open up trading counterparties that otherwise might not be open to trading with each other, I would not say that it would result in kind of less rigor overall in counterparty assessment, because the clearinghouse is rigorously assessing the counterparties it does business with, and for the non-dealer business, the dealer entities that are the clearinghouse counterparties are assessing, somebody's going to end up with exposure to the clients that are clearing cleared products. So the view of the counterparty risk and the ways in which it is managed probably change somewhat, but I wouldn't say it results in a diminution of credit monitoring.
Can you maybe give me a sense of sort of the arguments for your model, which, as I understand it, is to try and spread the risk across your other product areas as well?
This question we do get asked a lot, and the way that we look at the default fund is it is basically a mutualized insurance vehicle, and as with any kind of insurance vehicle, it is cheaper to obtain the insurance protection and cheaper to provide the insurance protection to a large extent if it's covering a more diverse pool of risks than if it's covering a more concentrated pool of risks.
There is a minority pushback on this where some clearing firms are questioning whether they should be taking this kind of risk on their balance sheets if it's in markets they don't trade in, and therefore they're unfamiliar with the levels of applicable risk, and that may generate, and I think Eurex Clearing has gone down the route of establishing a separate default fund, so people can actually decide whether they want to support that default fund or not. So there is a bit of pushback in this space, and I'm not altogether surprised in the current climate why there shouldn't be some concern about taking more risk onto the balance sheet by the clearing members. But I wouldn't pitch it higher than that, and I'm not sure that it's a significant amount of pushback.
Some of the arguments around this are, to some extent, I think, misinformed arguments. So our product's cleared by LCH ClearNet, so I'm not a risk management expert, but certainly in order to represent their view, two of the things Kim mentioned are very important. The first is that if you use a default fund which already exists and which a wide range of products are cleared into, that's because of portfolio diversification benefits. That's a very important benefit, and I think it's true to say you can safely have a smaller default fund to some degree if it has a wide range of products resting upon that default fund. That's the first argument. The second is, though, there's been a lot of focus on the size and the nature of the default fund. I think what's absolutely critical is that there should be no higher probability for CDS that you ever reach the default fund than for any other product. So it's actually all the protections that are in place prior to reaching the default fund which are the most important to focus on. And those are certainly the protections all the regulators are focused on in giving regulatory approvals for markets to go live. So the default fund is very important, but I think it's the entire risk management approach, including the way margin is set, the nature of the default fund, and also often overlooked is the default management process. What processes are in place to unwind positions if a Lehman-style default occurs? And all those are important elements in an overall picture.
Mm-hmm. Peter, you were going to say something.
Yeah, I think the two questions are related. The first one and the second one that you asked Kim. To John's point, people who are not familiar with the credit derivative market, don't play in the credit derivative market, don't really necessarily want to be subject to sharing a loss if the clearing corporation blows it for the credit derivative market. And a lot of those firms really aren't in a good enough position to judge for themselves whether the risk management standards are used by the clearing corp are applicable. And in a way that has nothing to do with unified default funds. It really has to do with whose default fund is going to be at risk. I can see major dealers saying, look, my contributions to the default fund can be used for everything that I I play with, it ends up with a slightly more complicated waterfall effect on who bears the loss. But that's the crux of it. Is I don't understand this market. I participate in this clearing corp. I don't want to share the loss if the clearing corp blows it.
We've been traditionally set up that even if you didn't have privileges for all of the products, you had the risk of loss for any product. We have a history, and LCH has a similar combined default fund approach, where even within the sets of listed derivatives, not everybody has privileges to clear every product set, but it's a combined default fund from a loss point of view.
But can I ask you both a question, which is, I understand entirely the view that says actually it's the front-end calibration of risk that is terribly important, and how we manage that, and whether we're margining correctly, and all those other things. But do you feel as CCPs that you have spread the word about how you do that enough amongst your clearing members, and particularly clearing members who might be nervous along the lines that you've mentioned? In other words, are you comfortable that they're comfortable that that's all in place?
We had some very detailed conversations with a number of clearing members who expressed questions in the beginning when we made our announcement that it was going to be a combined default fund. And then also our governing body is made up of clearing members, and it's by design, it represents a diverse set of clearing member interests. So there are more members of the governing body that come from the larger firms, because that's more of the risk of the clearinghouse is centered in those firms. But there are spots reserved for some of the smaller firm interests.
I think in terms of, again, to some extent speaking to LCH's experience, but I think it's important to stress the role of risk committees and others in approving any approach that goes forward. But one thing I think LCH would say is the challenge of clearing single names is rather different than the challenge of clearing index CDS, and that doesn't mean that it's necessary to use necessarily a separate default fund, but it does mean that the approach, when it's taken out to members, has to be really explained to a very high level of detail, and people have to have confidence that they're mutualising a risk which is properly risk managed. I think that's the key.
I must say I lose my grip a little bit on how you can apply confidence levels and all this central margining stuff for credit default swaps. When you look at a guaranteed book, almost by definition, by far the largest part of the book that you're going to be guaranteeing is at a point in the curve that just does not trade. Period. The end.
I think one point exactly on that, Peter, is that for single names, certainly LCH's position has always been that it's very important to have a default management process which ensures participation. So general market liquidity for single name portfolio closeout will probably not be sufficient to safely close out an entire portfolio. So you need a very formalised default management process where people are forced to come into the market and actually close out that book and participate.